What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to go over some very interesting data-driven analysis to help you with the best and most optimal entry points in the market and what specific things to really be looking forward to, right? So we've talked about the volatility, we've talked about percentage of stocks trading above or below their moving averages, but let's talk a little bit more about recessions, right? Because recessions are usually, in my opinion, and also backed by data, are considered to be one of the best buying opportunities for the market for equities. And I know there's a lot of fear around recessions. There's a lot of sort of a negative connotation around recessions. But I'm here to tell you that yes, it is from an economic standpoint somewhat unfortunate event because a lot of people do end up losing jobs. Unemployment rate starts to go up. But strictly from a market perspective, that actually ends up being one of the best times for the market as a long-term investor. So we're going to break all that down. As always, if you enjoy it, find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. There is a 16% annual discount that's available till the end of this month. So you will be able to access all the members only private videos. There's over 44 lectures and private videos for members only that you can access. These are all educational tutorials that you will be able to watch. And of course, on top of that, you'll get the early access to our MoneyVest Pro platform in 2024. And our MoneyVest Fair Value spreadsheet where you can track all the stocks that we have on the watch list, including their intrinsic value, and compare where the market price is. So it kind of helps you kind of guide in this market environment. So everything's going to be down below. You can also go to moneyvest.com and sign up over there as well. So this right here is the first thing that I want to go over. So Fed says the bond market's term premium is the reason behind rise in the treasury yields. So what is term premium? Now, term premium is nothing but the premium that investors expect depending on the term of the bond itself. So as I mentioned in our previous bond market update, right? So I did a video going over how this would be the most important video you watch because it goes over the bond market, the treasury market, and what's really going on with yields. And the term premium basically refers to the longer dated bonds because they are more susceptible to price volatility. What that means is that if you buy a 10-year bond, right? 10-year or a 20-year bond, you're more exposed to price volatility, meaning yields are going to go higher and lower over the next 10 years. Think about that for a second, right? Over the next 10 years, the yields are obviously going to go all over the place, up, down, sideways, circles, like they're going to go all over the place. So the price of the bond is more susceptible to the volatility that comes with a longer duration bond. Whereas something like a 1 year or a 2 year, you're not going to be as vulnerable or as exposed to that price volatility. So because investors want to be compensated for a higher price volatility, they want a higher premium, right? And that premium comes with the long dated bonds, 10, 20, 30 years, going higher than the 1, 2, 3 year, maybe even 6 months. Because it's much easier for investors to buy a 1 year bond and keep rolling it every year for the next 10 years, right? It totally makes sense because if the 1 year and the 10 year are trading at the same yield, what are investors more likely to choose? The 1 year, right? It makes sense because it's giving you the same amount of return as you would get for a 10-year bond. Now, of course, there's some caveat to that. I mean, if you do expect long-term interest rates to be significantly lower, then you wouldn't want to be going after the 1 year because that's going to be fluctuating. That's going to be potentially lower 1 year later. So when you're rolling out, it's going to be rolled out at a lower rate versus a 10-year, you're locked for the next 10 years. But if you do expect rates to be higher, if there's a lot of uncertainty, there's more price volatility, then investors do expect to have a premium on top of the 1 year, 2 year, the shorter end of the curve, which is why the long-term rates are going higher. Now, that's obviously is a problem for the economy, right? As rates continue to go up, there are higher and higher probabilities of a potential recession. And this is something that we have talked about. So 5.25% is a significant technical level. It's also a long-term resistance according to B of A. And what they have mentioned is that the 10-year constant maturity treasury note yields is 5.25%. Massive resistance, and it has already rallied over 800%. And in our previous videos, I mentioned how the yield curve is uninverting on the way up, and this is a very good example of that. And what you'll notice is that in the past, every time the uninversions taken place, we have seen the yields come down. That's the 10-year yield in 1990s, in 2000s, in 07, in 2020. But right now, present day 2023, it's kind of moving in the opposite direction. Not only is the yield curve uninverting, it's also happening on the way up as the yields continue to move higher, especially the long-dated bonds push higher. And the Fed says that that's happening because of the term premium, because there's more price volatility with respect to these longer dated bonds. Now, we've also talked about how every time the yield curve inverts, there is a potential for recession, and that's exactly why earnings take a little bit of a hit and markets also start selling off, right? This is the perfect example, perfect chart for that. You can see December 2000, markets dropped. We got June, July of 07, 08, June, July of 07, 08. We've got March of 2020, and this right, present day 2023, when the yield curve uninversion is happening. I'm not saying the markets are going to start selling off. And look, I could very much start creating these negative headlines and, be like, oh, market crash is coming. Like there's going to be a severe recession and, try to drive this FUD. And that might as well get a lot of clicks and views and whatnot. But I want to kind of help you understand that this is actually a good thing, not a bad thing, right? And the reason why I say it's a good thing is because our channel, our philosophy, our investing style is very much focused on looking for deals, right? We are constantly on the hunt for deals, for discounted opportunities, for buying opportunities. And, we're not looking for just like a 2% dip or 5% dip, for example, right? Even though that's great from a trading perspective, a lot of us investing for the long term, we're looking for serious buying opportunities when we actually do believe the markets are trading at a discount, they're trading at an undervalued level. And that's exactly what this represents, right? When we do see a spike in volatility, when we do see a spike in the uninversion that continues to move in the positive direction, that leads to markets trading in a little bit of that sideways consolidation pattern or even selling off. And this is a good example of since 1945, right? So we're going back over 80 years, 90 years. You'll notice that 87% of the times the economy has spent not in a recession. Only 13% of the times we have spent in a recession in the US since 1945. So once again, the rarity of something like this happening is really, really low, right? And the rarer the event is, the more solid the buying opportunity becomes, right? We talked about volatility, right? When it gets up to over 30, it's automatically in the 95th percentile and higher. When percentage of stocks trade below a certain level, automatically they're trading in, less than 7%, less than 5%, meaning 90% plus stocks are trading below their moving averages, which is again very, very rare. You combine those two indicators along with the fact that S&P 500 from its all-time highs is not necessarily down. It's not usually down over 20%. And when it is, again, it's a rare event, combined with the fact that, okay, if we are in a recession, the peak to trough sell-off is almost 30%. That's the average drop. And 12.7 months is the decline period, right? And after a recession, so S&P 500 returns post-recession 12 months later, on average, one of the strongest rallies you'll see is 43% on average, right? Some years, of course, April and March of 2020 was like the shortest recession. Markets rallied over 75% 12 months post-recession, 68% in 07, 08, 29% in 90, 91, and 33% in 2001, 2000, and 2001. So those right there are the last four recessions and how the markets have seen significant rallies post-recession. And finally, this right here are some more charts that I want to go over. And again, Bill Ackman also mentioned, right, that there's too much risk in the world to remain short bonds at current long-term rates, and the economy is slowing faster than the data suggests. So that in itself is also a pretty solid indicator from an economic standpoint that, look, the economy is slowing down, right? If there's contraction that happens, if there is any signs of a potential recession, that's only a good thing for the market. In the short term, yes, it may like the sky's falling apart, but over the long term, it's not like something that we haven't seen before. We've been through these recessions. We've been through these sell-offs. We've been through this together multiple times. So it is nothing but, very good DCing opportunities for the long term, in my opinion. And these are some things to also look forward to. This is NASDAQ percentage of stocks trading below their 200 simple moving average. Surprisingly, this week we are still down. Surprisingly, this week is, we're still selling off. And this right here, the green rectangle, is the one to watch. And this is S&P 500 stocks trading below their 200 SMA. And of course, when we get up to over 90%, it's pretty obvious that a short-term pullback or a long-term sell-off is likely. And right now, we're already breaching the first level, which is kind of like the dip level. And the second one is going to be that correction level. And the third one is the most serious buying opportunities, which is going to be the bear market level that I'm also watching for the S&P. So, it's kind of like finding that sweet spot when a lot of these indicators come together. And, based on the statistic, based on historical levels, they all scream buy, right? That's what they do, right? At the end of the day, that's what they do. You combine the volatility, you combine these two indicators, you combine, the yields, you combine the recession indicators, and all the stats that we've looked at. They all combined scream what? That it's a buying opportunity. And that's exactly what I wanted to go over in this video, is that, I know there's going to be a lot of FUD, there's going to be a lot of headlines and negative connotations around recessions, and, the macroeconomy is just like, going through a significant amount of, pain and contraction and whatnot. But I want to remember that on the other side of all that fear and noise is simply a buying opportunity waiting for you. That's all I wanted to get across in this video. So hope you enjoyed it and found it helpful. If you did, make sure that you drop a like, and don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available till the end of this month, and we'd love to have you on board in the MoneyVest community. We're doing some very exciting and amazing things to kick off 2024. So we'd love to have you on board. And as always, happy investing. I'll see you all in the next video.